What is cost behavior and how does that relate to measuring your output of production and your relevant range? Well, to start with, cost behavior is simply how costs react. That is the sensitivity of cost to changes in some part of the production or sales process. The most well-known or most applicable means or methods of testing this sensitivity is the cost volume profit analysis. By its very nature, it's trying to test the changes in costs with volume of production, right? So with that being said, the question becomes, how do costs change with output? Now, there are a couple of ways of doing this. Generally, what companies do is they use a function that assesses one, cost versus level of output. And if you were to graph this, you would put, again, one metric on the x-axis, one metric on the y-axis. And then you would use the linear slope formula, mx plus b, with m being the slope of the line and b being the y-intercept, where it crosses the y-intercept, that is, where output is 0. Okay, what would your cost be there? So basically, in that scenario, it would just be your fixed costs, no variable cost at all. But as production goes up and your total costs start to change, you would see the slope of the line. And variable costs, if they change throughout, you would see an actual curve in the line. Okay, now with that being said, if you're going to use this tool, how do you get the data or your points that you're measuring a point of best fit between, or a line of best fit between points? Some businesses, if you don't have much information, you would just use the endpoints, the high-low method. You would subtract the highest points for each metric, for each cost factor and each production factor from the lowest, right? And you would use that method of fitting a line between those points. The regression analysis, if you have a lot of data points that shows you all the different production points and layer levels over a period of time, then that could be a more accurate assessment of the cost function, basically how the costs are going to change with regard to production or output. Okay, now with that being said, the relevant range is an important concept or term with regard to assessing cost behavior, because it's the range, right? The range of output or sales over which cost should remain the same, or that the cost behaviors with regard to production will remain the same throughout a particular range of production or sales, right? The output range, the costs are going to remain constant, or they may escalate throughout, but they will escalate constantly throughout, or they may not change. If they don't change at all, they're a fixed cost throughout the period. If they're variable costs, they're going to increase incrementally the same amount with every new unit of production. If they're mixed costs, you're going to have a combination of the two in there. There's going to be a fixed element that's always going to remain constant throughout, but there will be variable elements in there that change throughout as well. So it wouldn't be a flat fixed cost, or it wouldn't be a straight variable cost. It would be the fixed cost mixed in there in some proportion, maybe not 50-50, but in some proportion to variable cost throughout a given range, and it would be constant throughout that range. And then lastly, a phenomenon called step cost is where you see some consistency throughout the relevant range, then you see a general step up with the next level of production. You would oftentimes see this type of thing during production where you have to bring another machine online, and but to meet the production needs. So you'd be consistent throughout one time, and then you bring, say, another machine online, and it moves the whole output cost relationship up another step to a different level, and it remains constant throughout that different level, right? But it just changes everything considerably. So it's more of a stepped approach rather than a gradual linear or curvature approach. So anyway, these are the primary cost behaviors that you'll see. This is the concept of relevant range mixed in there, and this is how you use the analyses between the two to assess changes in one and the effect on the other.